Gold smashes $5,000, silver $78. Thursday crash pattern. Shattered. What's coming Friday? For 3 consecutive weeks, every Thursday, like clockwork, gold and silver fell. Traders expected it. Markets priced it in. Everyone was positioned for it. And then Thursday came, and nothing happened. The pattern did not break itself. Something broke it. And whatever force was powerful enough to shatter a 3-week market pattern is still active. Tomorrow is Friday, options expiration day, and the people who know what comes next are not talking. Welcome to AU and AG, where gold and silver are not just metals, they are the language of the global economy. Now, before we go further, if you found this channel today, think of it like finding a letter that was written specifically for you. We'd like you to stay. Hit that subscribe button. The same way you'd renew a newspaper subscription you've trusted for 30 years, you don't cancel what has never misled you. And one more thing, drop a comment below. Tell us where in the world you're watching from right now. Whether you're in London at dawn, Lahore over morning chai, or New York before the markets open. We want to know. Because the people watching this channel are not ordinary viewers, and this story is far from over. For 3 weeks straight, something strange was happening in the gold and silver markets. Every Thursday, without fail, prices would fall. Traders noticed it, analysts tracked it, and after the 3rd consecutive week, the pattern had become so predictable that most market participants simply accepted it as the new normal. They called their brokers on Wednesday nights. They adjusted their positions before Thursday morning. They prepared for the drop the same way a farmer prepares for rain when the clouds have gathered 3 times before. The market had been trained. And that is exactly when the pattern shattered. This past Thursday, gold did not fall. Silver did not fall. The expected crash never came. And for anyone who understands how financial markets actually work, that silence was louder than any alarm bell. Because when a pattern that has repeated 3 times in a row suddenly stops, it does not stop by accident. Markets do not change behavior randomly. When something that was moving in one direction suddenly holds its ground, a force has entered the picture. A force powerful enough to absorb whatever pressure was pushing prices down and refuse to let them move. Something changed. And the critical question is not what happened on Thursday. The critical question is, who knew it was going to happen? Gold closed at $5,000. Silver closed at $78. These are not small numbers. These are historic levels that an entire generation of investors was told they would never see. Financial advisors laughed at the projections. Television analysts called the forecasts extreme. And yet here the markets stand, not at the edge of those numbers, but sitting comfortably on top of them. This is the part of the story where most people change the channel. Because if gold is at $5,000 and silver is at $78, and the Thursday crash pattern just broke for the first time in 3 weeks, then the audience watching this is faced with an uncomfortable question. What were the last 3 Thursdays actually designed to do? And now that the design has been abandoned, where does the price go next? The answer requires understanding not just where prices are today, it requires understanding why they are here. And that story begins not in the trading rooms of New York, but in the mines. There is a question that serious investors are asking right now. Not how high can gold go, but how did it get here without the world fully understanding what was happening beneath the surface? The answer is buried in the ground, literally. For the first time in recorded history, global mining data has confirmed something that was previously considered impossible. 2 consecutive years, 0 major gold discoveries, not one significant deposit found anywhere on the planet across 2 full calendar years. No new mines in the pipeline, no major projects capable of meaningfully adding to global supply within any relevant time frame. This has never happened before. Not during the World Wars, not during the Great Depression, not during any financial crisis, political upheaval, or period of market chaos in modern history. The Earth is not producing new gold fast enough for the world that is now demanding it, and the world is demanding it. Central banks, particularly those outside the Western financial system, have been accumulating gold at a pace not seen in decades. This shift did not begin overnight. It began quietly, methodically, after the global financial crisis exposed just how fragile dollar-dependent systems truly were. Then, something accelerated the process dramatically. When Russian assets were frozen and Russia was removed from the SWIFT banking system, central banks around the world received a message that no press release could have delivered more clearly. Dollar-denominated reserves could be seized. Gold could not. Almost overnight, central bank gold purchases doubled. Nations that had spent 20 years selling gold began buying it with urgency. And as institutional demand collided with a supply pipeline that was already running dry, the foundation for $5,000 gold was quietly being laid long before most investors ever considered it a realistic number. Silver tells a different but equally important story. Most primary silver producers have been operating with all-in sustaining costs well below $20 per ounce for years. Yet silver sat suppressed, trading at levels that made no logical sense against its own production economics. That suppression required active maintenance, and maintenance eventually fails. When the cost of keeping something artificially low finally exceeds the ability to sustain it, the market does not correct gradually. It reprices, suddenly, completely. And without warning for those who were not watching the foundation crumble beneath their feet long before the surface gave way. $5,000 gold and $78 silver are not the ceiling of this story. They are the moment the world finally looked down and realized the floor had already moved. Part 3 continues on your command. There is a city in southern China called Shenzhen. It is not famous in the way that Shanghai is famous. It does not carry the financial prestige of Beijing. But inside Shenzhen's bullion trading hub, something has been happening quietly for months that the mainstream financial press has almost entirely ignored. Whenever silver stocks arrive, they vanish. Not gradually, not over weeks, immediately. As if the metal were being pulled off shelves by invisible hands operating on a timeline that nobody is publicly discussing. The merchants inside that trading hub have been saying the same thing repeatedly. Whenever there are stocks, they are sold off quickly. That single sentence, spoken by ground-level traders in the world's largest silver-consuming nation, carries more analytical weight than a dozen Wall Street research reports. The numbers behind that sentence are extraordinary. Warehouse stocks linked to both the Shanghai Futures Exchange and the Shanghai Gold Exchange now sit at levels last observed more than a decade ago. A decade of industrial expansion, solar panel manufacturing, electronics production, and investment demand has drawn down physical silver reserves to a point where the market structure itself is beginning to buckle under the pressure. And the market is confirming what the merchants are seeing with their own eyes. The front-month silver contract on the Shanghai Futures Exchange has climbed to a record premium over the next active month. In technical terms, this condition is called backwardation. In practical terms, it means one thing with absolute clarity. The market is paying more for silver today than it is willing to commit to for silver tomorrow. That is not the behavior of a market with adequate supply. That is the behavior of a market that is quietly panicking. But perhaps the most revealing signal of all is not the price. It is the behavior of the short sellers. In a normally functioning market, institutions that have sold silver contracts they do not physically own simply roll their positions forward. It is routine. It is mechanical. It costs almost nothing. Today, those same institutions are paying deferral fees, real money, paid specifically to avoid taking physical delivery of silver they technically owe. When the people who bet against silver are paying penalties to avoid touching the actual metal, the message being sent to the market is unmistakable. The paper price and the physical reality have been living separate lives for a very long time. In Shanghai, those two lives are being forced back together, and the reunion is proving extraordinarily expensive for those who believed the paper version of the story. Part 4 continues on your command. There's a base in the Persian Gulf called Al Udeid. It sits in the small nation of Qatar, and it is exactly 720 miles from Tehran. Most people who follow financial markets do not think about military air bases when they are analyzing gold and silver prices. They look at interest rates, they study inflation data, they monitor central bank statements. But history has a different lesson to teach, and history is rarely polite about timing. In recent days, the United States quietly positioned nuclear-capable B-52 bombers at Al Udeid Air Base. No dramatic press conference, no primetime announcement, just aircraft, moved into place, 720 miles from Iran's capital. Simultaneously, President Trump issued a public warning with a specific timeline attached to it. 10 days. That was the window given for Iran to reach a meaningful agreement on its nuclear program. The language was not diplomatic in the traditional sense. It was direct. It carried consequence. And it concluded with words that financial markets are now being forced to price. Bad things will happen. Markets do not wait for wars to begin before they react. They react the moment conflict transitions from possible to probable, and the signal they send first is always the same. Oil moves. U.S. crude oil futures have already extended gains to 12% over the past month, reaching their highest level since August 2025. That is not a minor fluctuation. That is a sustained, month-long repricing of energy risk by institutional players who read military positioning reports before most investors finish their morning coffee. Prediction markets have responded with equal urgency. Strike probability odds have spiked to 54%. Additional forces and missile defense systems have been deployed throughout the region. The architecture of a military operation is assembling itself in plain sight. But here is what the history books confirm with uncomfortable consistency. Wars are not just political events. They are economic ones. Every major conflict of the modern era has produced the same sequence. Energy prices rise first, then strategic materials, then safe haven assets. Capital does not wait for the first missile to be fired. It moves the moment serious people in serious rooms begin making serious decisions. The B-52s are already there. The deadline is already running. And oil has already moved. Gold at $5,000 and silver at $78 did not arrive in a vacuum. They arrived in a world where nuclear-capable aircraft are parked within striking distance of a nation under a 10-day ultimatum, and the clock is still counting down. Part 5 continues on your command. There's a particular kind of silence that precedes transformation, not the silence of absence, the silence of pressure building beneath a surface that has not yet cracked. The global mining sector has lived inside that silence for years. Decades of suppressed metal prices meant decades of suppressed investment. Exploration budgets were cut, development projects were shelved, talented engineers left the industry entirely, and the companies that survived did so by operating as leanly as possible, waiting for a market that actually reflected the true cost of pulling metal from the earth. That market has now arrived. And one company's financial results have just told the entire story in a single quarterly report. First, Majestic Silver did not have a good quarter. They had a historically extraordinary one. Record quarterly silver production reached 4.2 million ounces. That number alone would be notable, but the context surrounding it transforms it into something far more significant. That figure represents a 77% increase year over year. Not a modest improvement, not a gradual recovery. A structural leap forward executed precisely at the moment when silver prices finally began reflecting supply and demand reality rather than decades of paper market management. Revenue told an even more dramatic story. $463.9 million in a single quarter, a 169% increase from the same period 1 year prior. For context, that means the company nearly tripled its revenue in 12 months, while the broader financial world was still debating whether silver's move was sustainable. The debate, it appears, has been settled. But the number that serious analysts are studying most carefully is not the revenue figure. It is the free cash flow, $250.4 million, nearly quadrupling prior results. Free cash flow is not a marketing number. It cannot be manufactured through accounting adjustments or creative financial presentation. It is the actual money remaining after every operational cost, every capital expenditure, every obligation has been met. When free cash flow nearly quadruples in a single year, it means the underlying economics of the business have fundamentally changed. Not improved, changed. And First Majestic is not an isolated case study, it is a preview. What one well-positioned miner demonstrates in a single quarter, the broader sector will confirm across multiple reporting cycles. Because the same metal prices that transform First Majestic's balance sheet are the same prices every other primary silver producer is now operating under. The mining sector spent years being told the good times were never coming. They quietly prepared anyway, and now the balance sheets are beginning to speak louder than anyone who doubted them ever anticipated. Part 6 continues on your command. There is a number that most governments prefer their citizens never calculate for themselves. Not because the math is complicated, because the math is simple. And simple math, when applied honestly to sovereign debt, produces conclusions that are deeply uncomfortable for everyone who has built their financial future on the assumption that the current monetary system will continue functioning exactly as it always has. That assumption is becoming increasingly difficult to defend. Consider what the United States looked like in the aftermath of World War II. Government debt had surged to extraordinary levels. The war had been expensive beyond any peacetime imagination. And yet, within that mountain of debt existed a critical structural anchor. Approximately 51% of federal debt was backed by gold reserves. That single fact provided the monetary system with a foundation, not a perfect foundation, not an unbreakable one, but a foundation nonetheless. A physical, tangible connection between the paper, promises the government was making, and something real that existed in the world beyond the printing press. Today, that connection has not merely weakened, it has almost entirely disappeared. Current U.S. gold backing sits at approximately 3%, not 51%, 3%. Total national debt is larger today than it was during the peak of World War II financing. Yet the gold reserve supporting that debt has shrunk from representing more than half of obligations to representing a fraction so small it barely registers as a meaningful anchor at all. But the projection forward is where the mathematics become truly sobering. Even in an optimistic scenario, one with no recession, no financial crisis, no unexpected geopolitical catastrophe, U.S. debt is projected to reach $64 trillion by 2036. That is double the 2023 level, triple the 2018 level. And it is the best case number produced by analysts who are professionally incentivized toward optimism. Now consider what the math actually implies for gold. The United States currently holds 261.5 million ounces in its gold reserves. If those reserves were required to back just 51% of projected debt at current trajectory levels, the implied gold price approaches $75,000 per ounce. That figure is not a prediction, it is arithmetic. Bill Bonner, in his work on sovereign debt and monetary debasement, identified the pattern with precise historical clarity. Governments facing debt service costs that exceed revenue capacity do not choose default. They choose inflation every time, without exception. And inflation, when it arrives not as a quarterly statistic but as a structural monetary event, does not ask permission before it reprices every hard asset on the planet simultaneously. The debt math is not coming, it is already written. The only question remaining is how many people will read it before it reads them. Part 7 continues on your command. There's a moment in every major market transition that most investors never see coming. Not because the signals are hidden, but because the signals arrive in a language that requires patience to read and courage to act upon. That moment is happening right now. The S&P 500 is currently displaying a pattern so rare that financial analysts have had to reach back nearly 2 decades to find a comparable occurrence. Today, 54% of stocks within the index are overbought. That alone is notable. It represents the highest percentage of overbought names recorded since June 2025. Institutions have been deploying capital aggressively, pushing select equities to levels that strain traditional valuation frameworks. But here is where the story becomes genuinely unusual. Simultaneously, 26.8% of stocks within the same index are oversold, also the highest reading since October. Aggressive buying and aggressive selling happening inside the same market at the same time, at historically extreme levels on both sides. This is not normal market behavior. This is a market in the process of making a decision. Since 2007, there have been only 13 recorded instances where both the overbought and oversold proportions rose by more than 10 percentage points within a single month. 13 times in nearly 2 decades. Last Friday was one of them. Under ordinary market conditions, these two metrics move in opposite directions. When buying intensifies, selling typically retreats. When fear enters, euphoria exits. The fact that both are simultaneously elevated at historic extremes means capital is not simply rotating, it is fragmenting. One group of institutional investors is aggressively buying certain assets while another group is aggressively abandoning others. And when that kind of simultaneous extreme divergence has appeared in the past, it has historically preceded one outcome with uncomfortable consistency. A major directional move. The critical analytical question is not whether a major move is coming. The data has already answered that. The question is direction. And direction requires understanding where the capital being pulled from oversold positions is ultimately seeking shelter. History provides a reliable answer. When equities fragment, when debt mathematics become undeniable, when geopolitical risk transitions from theoretical to operational, and when physical commodity markets begin breaking from their paper counterparts, capital does not remain patient. It moves toward what cannot be printed, what cannot be frozen, what cannot be created from nothing by a government facing a deadline it cannot meet with revenue alone. The S&P anomaly is not a stock market story. It is a capital reallocation story, and the destination of that capital has been trading at $5,000 per ounce, while the reallocation is still only beginning. Part 8 continues on your command. Every story has a moment where all the separate threads finally pull together into a single, undeniable picture. This is that moment. Tomorrow is Friday. Not an ordinary Friday. A New York monthly options expiration day. The single most manipulated trading session in the modern financial calendar. The day when institutions with enormous paper positions apply maximum pressure to move prices toward levels that benefit their expiring contracts. For 3 consecutive weeks, that pressure worked perfectly on Thursdays. Prices fell, traders capitulated. The pattern held with mechanical precision. And then this Thursday, it didn't. Something absorbed that pressure and refused to move. That something did not announce itself. It left no press release. It filed no regulatory disclosure. But its fingerprints are visible across every data point examined throughout this analysis. Zero gold discoveries for 2 consecutive years means physical supply cannot respond to demand regardless of price signals. Central banks accumulating gold at record pace means sovereign-level buyers are operating on a timeline measured in decades, not trading sessions. China's silver market, sitting at decade-low inventory with record backwardation, means the physical reality in the East has already diverged from the paper fiction maintained in the West. First Majestic's financials mean the mining sector is no longer operating at suppressed price assumptions. The debt mathematics mean the monetary system is moving toward a structural repricing that no single options expiration can reverse. The S&P anomaly means institutional capital is already fragmenting away from the existing system toward hard assets that governments cannot manufacture overnight. And 720 miles from Tehran, the B-52s are still there. The 10-day clock is still running. What happens Friday? The honest analytical answer is that no single session defines a structural transition. Friday's price action will be interpreted differently by different participants depending entirely on their time horizon and their willingness to read primary data rather than financial media narratives. But the larger question is not what happens Friday morning. It is what the world looks like when every force examined in this analysis converges simultaneously. Empty discovery pipelines, sovereign debt trajectories, Eastern physical markets decoupling from Western paper pricing, military positioning with specific deadlines, capital fragmenting at historic extremes across the world's most watched equity index. These forces did not assemble accidentally. They assembled gradually, quietly, and with the kind of patience that serious capital always exercises before it moves decisively. The Thursday pattern has been shattered. The Friday decision point has arrived, and the ones who read the data carefully, before the crowd finally looks up, will not be asking what comes next. They will already know.